And I'll go ahead and do a roll call.
Do we have enough for?
Landon Moore,
Him, don't call me.
Mark Gardner,
Here.
It's just taking so long.
Stephanie Elliott Williams,
Don't get me involved.
Okay.
David Holly,
Here.
Stephen Carter,
What'd you say?
Gregory
Do we have enough
Coleman,
for them? No, we don't.
Derek Challenger,
Here.
Trey Burke,
Here.
Michael Clater,
Here.
Councilman Dotson,
I'm here.
Harry Wilkes,
Here.
John Morrison, Brian Birnbaum,
Here.
Jim Whitney.
Here.
All right, and we don't have a quorum today.
Okay. We'll keep this moving pretty quickly then. Do we have a post-employment benefits report, Trey?
Yes, sir, we do.
Okay.
Good morning, everybody.
Morning.
Morning.
So we are at a 56% funded status with a $19.4 million liability and a $10.9 million asset. Probably not as high as we'd like it. However, it's been going up by about 10% every year until this last year. And it could have just been market. I'd have to talk to Greystone probably about how generally things have been going. I don't know if they have insight into VML VACO or what's going on over there, but just, we'll keep plugging away, keep on making our voluntary contributions, and we should see that number steadily rise over the next 2 years. So I don't know if there's anything really to worry about at this point, but we'll just keep making progress.
Good.
Thanks. What was the funding percentage?
56.
56%.
Yes, sir. But just note, it was 45 2 years ago, so we're, again, we're making progress.
Troy, one quick question. I know when we first started the OPEB fund, the goal was at some point to get to a point where these claims would be, or money would be paid out of the fund as opposed to coming out of the general fund balance. Do you know at what point we'll get to a point, or has that already happened, that the money is coming from here as opposed to coming from the general fund to pay it?
No, that'd be something I have to look into.
Okay.
I don't know of any money that's coming out of here. I've not seen. I guess there's been about $1.2 million a year of payments, but no, I don't know the rationale for when and how they do that, and if anything's still coming out of the general fund or not.
Okay.
You're asking for the projected fully funded date, aren't you? I'm sorry, is there a chair, should I ask? I apologize.
Go right ahead, sir.
Just jump on it.
Thank you. I think what you're asking for is the projected fully funded date.
Right.
Yes.
Is there not one for this?
I just know when this was created, it was an unfunded liability, and the goal of this was to get to a point where the funds could come from the actual OPEB fund as opposed to coming from the general fund balance. And I know we hadn't talked about this in a while, so I was just curious as to when that was going to occur. My thought was that it was in the future. I don't think we had got to the point where it was supposed to be doing that, but that's something I would do myself. I'll reach out to BACO and find out, and I'll get the answer by the next meeting.
And this is, and just for context for Dr. Dodson, this plan only started in 2018.
Okay.
So it's not been around for a terribly long time. And I think, to Mr. Challenger's point, it was kind of to get us kind of started just solely to take it off the general fund. So, and frankly, we're also making excess contributions in excess of the benefit payments out of there. So over time, we should get there, but we may still be a good ways away. And it's probably also a little bit of an arbitrary decision on when you were to start doing that. You just kind of have to say, okay, we're at 80% now, we're going to do it, but you could just easily say 90, 100, even 110 if you wanted to. It's probably just a decision for this board, maybe, on how they, if and when that policy would be kicked in.
That date, though, would be useful for budgeting. So we're trying to get people to think long term. as opposed to the short-term thinking that we've had for the last couple of decades.
And that's where the policy would come in, because if the policy is going to be, we're not going to do that until we hit 100% or 110% or 80 or 90%, that's going to impact when your fully funded date is. Does that make?
Well, given the current methodology, if we'd have some date, then we could decide whether the policy to change the policy.
Is there a methodology for that?
Yeah, I think we're a little premature for that. As Trey mentioned, or Mr. Burke mentioned, this was just started in 2018, and that's the reason why we try to do this, was to resolve the unfunded liability concern. So I think that's something that going forward we just have to plan for that, and I would do my best by the next meeting to have some additional information before we can do that.
Something to project, yeah. It could be arbitrary, but best guess.
Yes,
Yeah.
I'll work on that.
Thank you. Thank you.
Yes, sir.
All right, we'll pass on the approval of minutes because we don't have a quorum, and we'll hand it over to Brian and Jim.
Great. Thanks, Mark. Good morning, everyone. I'm going to have Jim talk a little bit about the markets. I'll come back and talk about the portfolio, but if I can just add sort of one comment on the discussion that you just had around the OPEB benefits. It's very common in the U.S. for government entities to provide these kinds of benefits to employees, but pay for those benefits on an pay-as-you-go basis. So there are liabilities associated with these benefits, but it's very common across the U.S. for there not to be any assets that are set aside to pay for those benefits. And so I give the city a lot of credit for putting money aside into this plan to eventually cover those benefits. Now, I know you haven't tapped those assets to pay for those benefits and you've been taking it out of the general fund, but the mere fact that you have set any assets aside to cover those future benefits puts you a little bit ahead of the game. So just to provide a little bit of context around what is common practice out there in the industry, I think you're far ahead of the game in terms of being able to come up with a long-term plan to pay for those benefits.
And I guess,
so,
Brian,
with that, I'll turn it over to Jim, and I'll come back, talk about 2024's results, talk a little bit about the start to 2025, and then obviously and certainly we'll answer any questions you may have. So, Jim?
Great to be with you all.
Let me see if I think I might be able to share my screen. Let me try to do that.
Wasn't sure if you or Stacy were gonna share that.
Brian?
Let me
Brian?
try it. Yeah.
We had one question, I think, that were related to the OPEB benefits from Trey.
I guess just one kind of to add to your point. If you look at Virginia and VML VACO, there's only about 40 localities that are a member of that, and the average funding level in that plan is only 63%. So it's like to his point, we've got a decision to make, I think, and I think we got a goal to set before we start using the funding, but we are kind of in line and we're in a good position to Mr. Birnbaum's point. That's all I have. Thank you.
Thank you.
Yeah. Okay, let me see if I can do this here.
That's going to be a fast meeting today, isn't it?
Wait a minute.
Way to go.
I don't know what that's about.
Okay. Hopefully everybody's able to see that. Okay.
Great, so we'll start on, I think it's page 6. Yeah, perfect.
Yeah.
I'm getting this stuff emailed.
All right, let me give you some thoughts about 2024, and more importantly, our views on 2025, and how we might be shaping the portfolio as a result. So what you can see here on the left is that it's been a terrific year, a prosperous year for investors. As a matter of fact, it's been a terrific 2 years. S&P rose about 23% last year, following a 24% gain in 2023. So these combined gains have offset the 20% loss that we saw during the 2022 pandemic period. In terms of 2024, it was really a second half story. And I think it's worth refreshing on that for just a minute, because if you may recall, the first half of the year had significant recession fears. And then late summer, the Fed surprised us all with a 50 basis point cut in September, and it was followed by two successive 25 basis point cuts. And it was at that particular time that the market began to race, and it was risk on, and investors were excited about a policy easing environment for the economy, which is typically pretty good for stocks. So, our best guess going forward is that this S&P 500 index, which we'll look at more closely in just a few minutes, will be up somewhere between 5 to 10% from where we're at today. So our base case is about 6,500 on the S&P, and from where we're at today, that's because we've had a little bit of a rally here in the first month of the year. That's about 8% from where we're at. But all of this was powered by an economy that grew 2.5% in 2024. Now that's a bit slower than we saw in 2023, which was just a little over 3%, but it was still a very, very sturdy pace. Again, for an economy that many thought was going to be tipping into a recession. And the Fed expects the economy to grow just over 2% for 2025. Next slide.
There you go.
So here we're just looking at 2024 performance, upper left. You can see U.S. Treasuries, investment grade bonds, pretty much break even. It was all mega cap stocks. S&P up almost just over 23%. Master limited partnerships and gold, all indications, by the way, that the economy is doing well. As we see also on the far right, financials had a terrific year as well. We all know the tech story. In the bottom left, if we look at the different parts of the world, emerging markets up 5, Europe up 6. It gets a little bit better, but again, the U.S. was up 3, almost 4x what we saw in Europe. This next slide got a lot of attention, so we'll close out the year reflecting on it because it is significant. This is all about the Mag 7, so Apple, NVIDIA, Tesla, Amazon, Microsoft, Meta, and Alphabet. You can see how much it powered the S&P and overall market performance last year. So that base index going back to 2022 is up 129%. The S&P itself is up 69, and we strip out the Mag 7 and see how the S&P performed without it. You can see it's up 40%, 41%. So dramatic impact. And now that's also manifesting itself in the top 10 stocks in the S&P, which is in the right, 38%. So almost 40% of a very, very broad index is now concentrated in 10 stocks, and that's a record.
Yeah. Great one.
Interestingly, if we look at the next slide on the right side, S&P 500 index up a little over 23%, average performance up 13.5%, and then sort of the middle, if you will, the median up 10%. But there was some losers here as well, and I found it interesting that 34% of the index was down for the year. So pretty big number. Again, it just highlights the disparity underneath the current of what was happening with the broader index. This next slide is really, I think, one of the most important slides for us for the year. And if we're looking at the left side of this slide, we're looking at the S&P 500 index year-over-year change, and then the earnings breadth revisions. So, as we look at the S&P 500, how broad is the rally? How significant is the improvement in earnings for the S&P 500? And you can see it tracks pretty closely. There's a reasonably tight correlation here. But with the strong performance that I showed you on the first slide of the index, this has created a wedge, a gap between actual earnings and the S&P 500 index itself. So this will course correct one way or the other. Either the index will come back down to reflect where earnings are, or our hope or expectation is that those earnings will start to rise. The significance of this gap, however, is that if we look over longer periods of time, when we do get these big gaps, it creates periods of volatility because the market clearly is priced for perfection. It's at 23 times forward earnings. And so there's just not a lot of room for error. And earnings have grown 7 to 8% over the last trailing 2 years. Some quarters a little bit less than that. And expectations are that they can grow to 10 to 11% going forward. So good news is that the first quarter earnings, which reflect fourth quarter of last year, so far have been off to a very good start. So it looks like the earnings number will start to move up. We'll look at this in the next slide as well. So here you can see just very simply the dark blue line is 2024 earnings per share. That's on the left axis, and the lighter blue is 2025 estimated earnings for the S&P. And you can see in 2024, for the most part, these are forward expectations. And they've been trailing down for some time, started to turn up towards the end of the year. And pretty much the same was true for estimates for 2025. And the good news is they've started to turn up. So we're looking for somewhere between 9 and 11% growth in these earnings to help close this gap. But if we were to look at this more closely, you would see that it's very back-end loaded in 2025. I don't want to call it a hockey stick, but it is back-end loaded, and that's where the risk for disappointment can come in our view. Next slide is back to the inflation discussion, and if we look at the bottom right, the core personal consumption expenditure index, which is one of the Fed's favorite. We're tracking this over time from 12 months to 1 month in. And if I were to update this slide, the December number came in at 2.8%, so better than the 3.2% you see here in this slide, but still well above the 2% number. So this is putting some pressure on the Fed to maintain current interest rate policy. And if we look at the next slide, it's not in any one area, right? So we're looking at crude or home prices or insurance or broader commodities. This is what's giving the Fed some pause. And so Chair Powell at the recent meeting, he said, inflation does remain somewhat elevated, and labor.
I don't know what.
Did we log in?
I have an IT person coming because I was like, I've never seen that.
Hey, Mark, great meeting today.
I have no idea.
We're starting to get some good positive numbers.
Oh, wow. I don't know. And I have an IT person coming. I've never had that happen before because I should have the account that it's not the free account. Oh, goodness. I'm so sorry.
Try starting the meeting.
Let's do it again.
Well, there's the meeting room on your bottom right.
I didn't write them. Oh goodness.
Did you pay your bill last month?
Oh, right. I know, right? I tell you, I don't know. I've never had that happen before. I don't know why I need to invite them again. I'm so sorry.
I think Jim's still talking.
Oh, it's up there at the top right where it says 854.
Brian.
Okay.
Sorry, I don't know what happened there.
Yeah. And I have an IT person coming.
There we go.
Goodness. I'm so
Let
sorry.
me see if I can pull my screen back up.
Okay.
Sorry about that.
No, sorry. On our end. Not sure
Okay.
what happened.
All of a sudden, there's Brian in the top right corner.
Jim, I think you're on mute.
There he goes.
Can you say something, Jim? Okay.
Congratulations on your election results.
Well, while Jim's dialing back in, maybe I'll just
Hopefully we
spend
can glad
1
to
minute
see it.
here.
Gonna get something to move.
I think it was in early December.
Slow for me.
Yeah.
I was at the city council meeting to talk about the retirement plans, along with John Morrison from Hancock. So that meeting went well. There were a few questions. Results were, good, north of the assumed rate of return that John uses to discount the liabilities. So from a from a cash planning and budgeting perspective, contributions from the city to the plan are going to be stable, given the pretty stable, I'll say, given the strong plan results relative to what John assumes in his model. So, Councilman Dotson, I don't know if it's hard to see if you're still there. I think you are, but I don't know if you had any other comments you would make from that meeting.
Just the one question I left you with at the end, and we'll get to it in a minute.
Yeah.
Okay, sorry about that.
All right, Jim, is this the slide you want?
Yes.
Okay.
I wasn't sure because Brian occasionally will just disconnect me if he thinks I'm going a little too long on the economy, so I wasn't sure where the challenge came. So I have two more slides, and the slide that Brian has up now is just an indication that we have inflation sort of coming from different areas. A lot of times we hear about rent and insurance, but it's broader than that. And the Fed now acknowledges that inflation remains somewhat elevated, and labor conditions, which is what was the primary concern when they cut interest rates by 50 basis points, clearly remain very, very solid. So there's no rush for them to adjust their policy stance. The probability of a rate cut in March is now, it's below, I looked earlier this week, it was below 15%. And so maybe we'll see a rate cut in the back half of the year. But the first half looks, given how strong the economy is, and the stickiness of this inflation, it doesn't look like we're going to get a rate cut in the first half.
Mm-hmm.
And then finally, there's a lot of discussion about being able to cut the federal spending, but the reality is, if you look at the components of that spending, what makes up those payments, there's just very, very little room to cut. we've got Social Security, Medicare, Medicaid, defense, interest, which now is going to eclipse has eclipsed defense. So there's just not a lot of room. So we've been a little bit skeptical about the potential to make any meaningful progress here, just because so much of the total pie is fixed. So I'll stop there and turn it back to Brian, unless you all have any questions for me.
Okay, great. Thanks, Jim. And then maybe one final comment from the city council meeting. John and I have just started a conversation around the assumption that he uses for the assumed rate of return. As I mentioned earlier, it's 7.25. It's been 7.25 for a while. I would say the trend in the public retirement world over the last, call it 10 years, maybe longer at this point, has been to ratchet those assumptions down a bit, to the point where the average is now around 6.9. I'm not suggesting that the number that he uses and that we use needs to change, but something that we should talk about and discuss to see if a change is warranted. And but obviously we'll have those conversations and any analysis around that and the potential impact of it with this board. We're just not at this point ready for those conversations, but I just wanted to get that out there a little bit, so it's not a surprise when we bring it up. And again, I'm not suggesting that anything needs to change, but since we haven't looked at it in a while, it's worth having a fresh look to either affirm or make any changes that might be warranted. So, any questions or comments about that?
Thank you for bringing it up early.
I'm sorry?
Thank you for bringing it up early.
Sure. Okay. So hearing
Hey, Brian,
Yeah.
when do you expect that conversation to start taking place with this board?
I would suspect we can probably tee up the topic at the next board meeting and sort of frame the issues in a general level, what the potential impacts are there, maybe back of the envelope kinds of analysis and what it potentially means to cash contributions going forward. We'll do a historical look back. The reality is we haven't really felt compelled to make any changes to that assumption because we've been able to hit that assumption going back a number of years. Obviously, 2022 is an unusual year, but the 7.25 is a number that we've been able to hit, pretty regularly, and so we haven't been felt compelled, but to make a change. But the reality is, and Jim touched on this a little bit in his comments, the valuation level of equity markets today they're stretched. They're high relative to history, and so anytime you have a starting point where the valuation levels in equity markets are high relative to history, what you tend to see in the future is lower returns than what's sort of the typical long-term return of equity markets are. And so it's possible that while we've been able to achieve that 7.25% return going back historically, it may be a more difficult hurdle to achieve given the starting point of equity market valuations today. But David, I would think the next meeting we'll have some information to share and sort of start those conversations. It's not going to be something that you're necessarily going to say, okay, yep, in one meeting, say, yep, we need to make a change, or no, we don't need to make a change, but it'll be a conversation that happens over, I would say, multiple meetings.
Okay, thank you.
You bet. Before I get into the portfolio, I wanted to provide a little bit of context, and I'm sorry I don't have a slide on this. I was looking at this for another client the other day, and I thought it was relevant, so I just jotted some numbers down, and so I apologize if I'm reading from my notes here. Jim talked about the second consecutive year of 20+% returns for the U.S. equity market in 24. On top, 23 was a good year, 24 was a good year, both years over 20%. So I went back in history to see how common or unusual it is for the U.S. equity markets to generate 2 consecutive years of 20+% returns. And then I wanted to see, well, what was sort of the third year, the year after 2 consecutive years of 20+% returns. And the information I found and the data I saw was kind of interesting, so I thought I'd share it. So if you go back to 1926, there were 13 times, not counting the current 2 consecutive years of 20+% returns. There were 13 times, going back to 1926, where the U.S. equity market returned 20% plus or more for 2 consecutive years. In 5 of the third years, so 13 times in 5 of the subsequent calendar years, the U.S. equity market was negative. And on average, the decline in that third year after 2 consecutive 20+% returns was down 13.5% on average. And when you look at the total number of times, so again, 13 times 20+% returns for 2 consecutive years, the average return in the third year, which includes those 5 periods that had negative returns, was positive 9%, 9.2%. So when you look at history, 2 consecutive years of 20+% returns is unusual. It's not unheard of. And history tells us the third year is more likely to be positive than negative. And even in the circumstances where the third year was negative, I would classify an average down year of 13% roughly as not being catastrophic. So there's a lot of debate and focus, and Jim talked about our outlook somewhere between 5 and 10% this year. That would be squarely in line with the evidence that we see going back to 1926 on what happens in the third year of after 2 consecutive 20+% returns. So anyways, thought it was interesting. Just wanted to share that. So and again, it's right in line with what our outlook is. Let me go here first. Fourth quarter was a down quarter for the markets. You can see that in the fourth quarter we were down a little less than 2% under the benchmark. For the full year, we're up 10% below the benchmark, and then you can see the period from which we started to have discretion here, 8.1% net of all fees versus a benchmark of about 8.9. We've talked a lot about performance. We've talked a lot about portfolio structure and positioning. I'm going to come to some changes we made in the middle of last year. It's obviously very early stages of those changes. The timing of some of those changes we made weren't great because of what happened in the second half of the year. But I'm happy to say the early part of 2025, and I'll talk a little bit about this when I get to some of the managers, the positioning of those portfolios and the changes we made have really started to work. We're actually outperforming by about 30 or 40 basis points so far here in the early part of of 2025. So, so the changes we made, although right out of the box haven't worked, you know, we're really getting some traction with the positioning of those portfolios, and it's working to our benefit here in the early part of 2025. At the last meeting, at the last retirement board meeting, we made a recommendation to change the benchmark and just to the equity component of our benchmark, and just to remind this group the rationale for those changes. The old benchmark really underweighted the small cap area of the market relative to the entire opportunity set. And so it's the way we've always invested, to have sort of a market weight to small cap stocks, but because our benchmark did not have that market weight in it, and we had a market weight to small cap stocks, that allocation difference between the way we put the portfolio together and what we're being measured against, there was a little bit of a mismatch. And so we recommended a change to the benchmark to include more of an allocation to small cap stocks, to more closely align to what the opportunity set really is, and the way that the portfolio was constructed and put in place. That benchmark change becomes effective January 1st of 2025. We will not go back historically and make that change. The old benchmark will continue to be the benchmark up until 12/31 of 2024. But in the first quarter, you're going to see a new benchmark. I just put the return in the fourth quarter of that benchmark, which is the City of Portsmouth blended update, to say if that benchmark was in place in the fourth quarter, what would have its return been? And you can see it's a little bit lower than what the actual benchmark was, which was more in line with how our portfolio performed in the fourth quarter. Again, we're not suggesting by any stretch we're going back historically, but I just wanted to provide that information in that context, just to give you a sense as to how the portfolio did. The portfolio was structured and how it's likely to look relative to that new benchmark. The other thing I want to say back on this slide, we talked about the sort of the 7.25% return, the assumed rate of return that the actuary uses. The plan year, as you know, is July 1 to June 30 time period, so it syncs up. It doesn't quite sync up with calendar year returns. As of the end of December, we are halfway through the current plan year. And our return for the current plan year, for the first 6 months of the year, it's about 3.5%. Now that doesn't include the returns in the early part of the first quarter, which are positive. So I only bring that up to make the point that even in the current plan year, despite what I said about kind of reviewing the assumed rate of return, granted we've got roughly 6 months to go, we're tracking the returns that the actuary assumes. So assuming no changes are made to that, we would presume cash contributions are going to be relatively stable. Again, we've got 6 months to go. I'm not banking on anything, but at least for the first 6 months and maybe 7 months of the current plan year, things are tracking as we would expect and as the actuary assumes. Again, that's good from a cash contribution perspective. Let me spend a few minutes on sort of the active managers, and as I mentioned earlier, out of the box with the changes that we made to the portfolio and the active manager lineup, timing wasn't great, but things are really starting to perform a lot better in the early part of 2025. So here's the roster of the various managers we have in place. I'm not going to go through each one of these, but from a long-term perspective, all of these managers have strong long-term performance. Doesn't mean they're going to outperform in every single year, and in fact, even very good managers can go through extended periods of underperformance. We feel very good about the way this portfolio is constructed and put together. I do want to call out a couple of different managers, though. One of the more significant changes that we made in the middle of last year was the introduction of a global equity manager. So historically, we've segregated U.S. stocks and non-U.S. stocks and the different sort of, large cap stocks and small cap stocks. And we've managed the allocation between U.S. and non-U.S. in a way that sort of closely approximated what the benchmark's exposures are. We introduced this concept of a global equity manager that puts in some ways, the onus on them or the decision-making ability on them on whether they think U.S. stocks or non-U.S. stocks look more attractive than the others. So they have the ability to overweight or underweight certain areas of the world as a way for them to potentially add value. Now, you'll see in the sort of the middle of this page here, under global equities, hasn't been a good start, at least the first 6 months, or the last 6 months of 2024. You can see that they've underperformed fairly dramatically. This is a portfolio that looks very, very different than all the other investments that we have. And this is one of the reasons why we really like this portfolio. As Jim talked about in his comments, when you look at the U.S. equity market in particular, there is a high degree of concentration in the top 10 names, and those top 10 names happen to be mostly technology names. We've talked about this for, at this point, years now, and the risks that presents. This portfolio is constructed very differently than what the overall market looks like. And I just kind of rattle off some numbers to give you a sense as to the differences. When you look at the global equity benchmark, technology stocks represent about 25%. It's 26% of the global equity benchmark. This manager in this portfolio has 10% exposure to technology. So a massive underweight to those names. And those names happen to be, as we've talked about, some of the highest valued stocks around the world. So significant underweight position relative to that. Now, we've got a lot of technology names in our S&P 500 exposure. Again, when we hire active managers, we're hoping and wanting them to do something different. Where they do have bigger exposures relative to the benchmark are in places like healthcare. They have a quarter of the portfolio in healthcare stocks. The benchmark has about 10. Energy stocks, they have about a 10% allocation. The benchmark has 5. Then utilities, about 12% versus 2. So the way they put the portfolio together, very different than the other exposures we have elsewhere in the portfolio, and that's one of the reasons why we like this portfolio, because it helps to diversify and gives us some different exposures that we didn't really have prior to the introduction of this manager. Happy to say that they're doubling the return of the benchmark the early part of 25. They're up almost 7%. The benchmark's up about 3.5%. So again, getting stuff that looks different than the other investments we have, critically important from a diversification and risk reduction perspective.
If I may add, the timing, the entry point, unfortunately didn't work. But the manager, had we held this manager for the entire year, they were up almost 21%, and the benchmark was up, I think, 17. So they delivered another very, very strong year. It's just unfortunate that our entry point didn't capture that full year's performance.
Short-term performance
Very
is
short
a
period.
challenge for anything. And again, it's 6 months. Reality is active managers can go through even longer periods of extended underperformance. As Jim talked about, you don't necessarily see that with this one. And again, as we flip the calendar year, things have started to move in the right direction.
Brian, what is the total weight of non-U.S. stocks, equities now? What's the weight of the international and emerging to the total equity portfolio?
I'll come here, Mark. So if you look on the table here on the left-hand side on this slide, we're slightly overweight equities. So our target is 70%. And this is as of, by the way, this is as of December, end of December. Our target weight is 70% to stocks. We're at about 71.5. So we're slightly overweight equities. When you look at the composition of the equities, we are virtually right on top of the benchmark in terms of the non-US weight. You can see 17.9% versus 17.6 for developed markets. We're slightly underweight emerging markets. But Mark, to answer your question directly, there really is no material difference in the way that our US and non-US exposure is positioned relative to what the broader index looks like.
Okay.
Okay. One other comment on sort of active management here, and it's below the global equities, it's under international equities. The way that we structured the portfolio is in US small cap and in international stocks and emerging markets, we have effectively two active managers in each space. One that invests in growth stocks, whether we're talking about small cap growth in the US or growth stocks outside the US. And we pair that with a manager that focuses on value stocks. So in the international equity component, our growth stock manager is a firm called Walter Scott. And you can see that virtually right in the middle of the page here. You can see pretty negative returns for that portfolio, particularly in the fourth quarter of 2024. We compare them relative to the standard benchmark, the standard EFA benchmark, which includes both growth and value stocks. And we do the same for our active value manager, which is the one right below it, Artisan. Growth stocks outside the US were the absolute worst segment of the non-US equity market. In fact, growth stocks in the fourth quarter for non-US stocks were down over 9%. So while you see it down, 9.7% in the fourth quarter, it's not so much that they're doing a bad job, it's the market in which they operate. But importantly, when you combine the two of them together, it works over long periods of time. The alpha that the growth guy is able to generate over long periods of time, and the alpha that the value guy is able to generate over long periods of time, gets us in a better spot relative to the core benchmark.
All right.
One quick comment, and it's we don't spend a lot of time typically talking about this, but on the alternative side, just to remind this group, we have an 8% target to alternatives. We have investments in two different areas in the alternatives bucket. We have investments in real estate investments, and then we have a couple of what's referred to as multi-strategy hedge funds. And the whole idea behind this allocation was always to be a diversifier to the portfolio and an opportunity when interest rates were zero to be able to generate better than bond-like returns. And in fact, it's worked out pretty well. It's, the returns that have been coming from this portfolio have done better than the broad bond market. And that was always the intent of the allocation. We conveyed about a year or so ago of our intent to start to exit from one of the real estate investments. And before the end of the year, we got about $1.6 million of our investment back in cash. The reason why we're stepping away from that real estate investment is because, because of COVID and hybrid work and work from home, the demand for office space isn't what it used to be. And so we wanted to step away from some of that exposure. And the reality is with what happened in 2022 and the Fed aggressively hiking interest rates, the interest rate environment today is very different than it was when we originally went into these investments. So it'll take time for us to get our money back, but we did get about a quarter of our money back right at the end of last year. And so I just wanted to pass that information along. We're going to use that money, by the way, for to pay benefit payments. And so we're going to sort of ratchet down some of that exposure a bit, but I just wanted to pass that information along.
Good to know.
So with that, I'm happy to answer any questions that you may have about the portfolio, about positioning, about anything that's going on in the world.
Brian, we only got about 5 minutes before we have another IT failure unless they can intervene, so we'll need to speed it up. No, seriously.
Yeah, I see it.
Brian, how did we look in the first month of the year? You said
good.
Good. All right.
Good. We're outperforming on the equity side. We're outperforming on the bond side.
Okay.
Yeah.
All right, well, we'll move on to, I'm sorry, any more questions?
Oh, Mark, sorry, I did
sorry.
jot some numbers. I'm sorry, I did jot some numbers on it. We're up about 4% on the equity side, positive for bond market's up about 1.5. So
Good start.
Do the blend. We're probably up somewhere around 2.5% for the period.
Great. All right, well, let's move on to John Hancock and Perry. I'm not sure how much time we've got left on the Zoom meeting.
7 minutes and 10 seconds.
Let me see if I can do this in 6.5. I'll pull the screen real quick.
No pressure, Barry.
Right. No problem at all. So in the interest of time, I'll lead off with the thing probably everybody's wondering. This is the funded status reconciliation for Q4. Overall, the funded status is at 71.5%. It's pulled back just slightly just because of what the fourth quarter did investment-wise. As Brian pointed out, it's made a comeback here during the first month of 2025, but this is where it stood at 12/31. All right, and then I will move through this pretty quickly again in the interest of time. So for 2025, the participant webinars that we have available at John Hancock are listed here. If your participants have an email address on file with John Hancock, they'll receive an invite to sign up for these webinars. They can view them live, or each one as it's done is also recorded and can be looked at after the fact on a recorded basis. That said, only one exception, and that is the October webinars on the Social Security. That's done by the Social Security Administration, and they will not allow us to record those webinars. So to make up for that, we have about 3 or 4 times as many time slots to try and accommodate everyone, but that is by far our most attended webinars during the year. The plan checkup, this is overall, slight decrease in the number of participants, but that being said, it's still relatively stable. And this is the asset values for the 2 plans split between with an overall of about $191 million. Status overview, again, as you can see through time, we do have 604 retirees in paid status. 36 participants have term vested benefits they have yet to start receiving. This is for the fire and police system. And then again, for the monthly annuities, you can see those payments here. Those 1231 numbers do not include the supplemental payment that went out. Just because it wasn't a normal annuity under the plan, it was that extra payment. And then still one active participant in the fire and police plan. And then you can see the change. We've got 3 more participants receiving periodic distributions, 1 spousal benefit due to a deceased participant, and then 3 deceased participants who had benefits ending with 17, 33, and 54 years in pay status. For the supplemental system, there are no longer any, I apologize there. These are pretty stable again, about 4 participants that have dropped off, 1 additional participant that began receiving benefits back in September. And again here, the monthly annuities, and this again does not reflect the supplemental payment. And 6 participants still active. And then again, you can see the numbers, 4 deceased participants who are no longer receiving benefits, and years of receiving benefits, 7, 21, 22, and 28 years. So a significant look there. I won't bother with the John Hancock value statement here. This is the overall expenses for the investment management, the Greystone investment consulting fees, the John Hancock fees, and then the total fees for the plan year.
There it is. That's a sheet I was waiting for. Thank you.
No worries. And that wraps it up. So I will stay under my time limit.
Thank you, Barry. Any questions?
I did have a question, and this is kind of me as my first time sitting in this chair, but we have bonds that are pretty heavily involved in this system, but they're not something that necessarily gets shown if you're the retirement board. It's kind of on the city side, that's where the bonds exist. And in my mind, I can see how if you're the city and you've got, tens and tens and millions of dollars of debt still to pay on it, that kind of, but you're saying that's where our funding is on the retirement system side. You kind of end up in this balance where, okay, your funding level is probably only in the $70, $80 million from the city's perspective, but from the retirement board, you're at 170. And so I didn't know if you were aware of any localities, especially there are a handful of localities that have kind of gone Portsmouth's, pension bond route, but if any of them have done anything to make that adjustment on a philosophical basis, or if it's probably wrong to do it on a philosophical basis for any reason.
So the funding that we show is actually what's there in the retirement plan trust, so it does not reflect those bonds, as you pointed out. Brian, you may have some more broad insight there.
Yeah, I'll try to talk fast in less than a minute. Yeah, Trey, you're right. From an overall sort of financial perspective, the bonds are an obligation of the city, as effectively is the pension liability. So thinking about it in a cohesive way gets you to a very different point than when you just look, as Barry talked about, the pension trust fund. It doesn't, other municipalities don't really think about it that way, but from an economic perspective, I mean, you're kind of right. The one thing I would say is that, the reality is the issuing of those pension obligation
That's it.
Okay, what should I do?
Jump back into the meeting. Everybody that was added to the meeting, they just need to join again. Click on that link. Everybody.
All right, so don't worry about that because that's not connected to everybody.
Everybody needs to join back.
Okay, yeah, okay, got you. Not Zoom. I'll do it.
Who's the person that would be the best to direct the question about, again, the fully funding date, projected date? Is that
Sorry
you or
about
them?
that again.
For OPEB or for this?
The one thing I think that might be interesting to look at is sort of what the interest costs on the pension obligation bond has been since issuance, and the investment return that was generated within the pension trust from using those proceeds to contribute to the pension plan. In effect, what you're really, the pension obligation bond represents leverage, and so I think the reality is the investment return that was earned off of those assets is going to significantly exceed the cost of the debt. But Trey, to your point, it is an obligation, doesn't really get factored into these kinds of discussions, but from an economic perspective, it's something that the city's gonna need to pay down.
And I think the intention is to, but I also want to make sure that is always front of mind when we talk about our equity or our position in the retirement system. We're at 74 if you ignore all the money we owe. And so it's like, it's something that we need to do. I think it was smart for us to do, but kind of don't lose sight of the mechanism. Don't lose sight of the car that we're driving to get us where we're going, and don't put it in a position it's not really equipped to handle.
Yep.
Yeah.
Understood. Agreed. Yep.
Thank you.
Any other questions? All right, thank you, gentlemen. Appreciate it. We'll see you on May 1st.
Perfect.
All right.
Thank you very much.
All right. Meeting is adjourned.